Trendline is a simple and reliable tool because markets always moved in cycles of trending, consolidating, trending, and consolidating. Trendline can clearly show the market structure, and it has a high probability to show the start of a trend. Therefore, Trendline has forecasting power, and this is why Trendline is widely used in trading. And as a beginner day trader, you need to master the Trendline trading skills. So in this video, I'm going to show you everything about Trendline. Let's get started. I'm going to cover the following topics. Number 1, the Trendline basics. I'm going to show you different types of Trendline and how to draw a Trendline. Number 2, how to use Trendline in day trading. Basically, there are two ways. The first way is to use the Trendline as a support and resistance. And the second way is to trade the Trendline breakout. Number 3, in the last part of the video, I'm going to show you some trading examples using Trendline. What is a Trendline? To answer this question, we have to answer another question first. What is a trend? As we all know, there are two types of trends, the uptrend and the downtrend. And the definition for uptrend is to have higher highs and higher lows. And the definition for downtrend is to have lower lows and lower highs. The concepts are very simple. However, they are very easily to be ignored in the real day trading. Let's have a look at this chart. There are a lot of highs and a lot of lows. However, when we define the trend, we only use this high, this low, this lower high, and this lower low. So we call the blue ones the major highs and major lows, and the yellow ones the minor highs and minor lows. When we define a trend, we only use the major highs and the major lows. And then here comes the definition for trendline. So trendline is the line to connect major highs and major lows as the trend develops. Here, the keywords are major highs and the major lows. How to draw the trend line? Based on the concept, we need to connect the major highs and major lows. In this picture, we have an uptrend. We also have the minor highs and minor lows, though they could be on the trend line, but it's not necessary. Another thing is that we need to concentrate on the big picture. I mean the chart on your whole screen. No matter if you are trading 5 minutes, 15 minutes, 30 minutes, or 1 hour chart, we need to use the major highs and lows for your whole screen. Second, to draw the trend line, we need to fit most of the highs and lows. So here's an example. For this low, the trend line is at the bottom of the tail. And for these two highs, it is crossing the tails. So really doesn't matter as long as we can fit most of the highs and lows, no matter it is touching or it is crossing the body or tail. In an ideal situation, we should have the high-low pattern. However, in the real day trading, it is not always the case. Here's the example. We have the minor high and minor lows here. We can also have a trend line. So we need to be a little bit flexible when we do the day trading and draw the trend line. Sometimes you will see the single touch of the trend line, like the two highs here, and sometimes you will see a consolidation of the market approaching the trend line. It really doesn't matter because for the consolidation, if you take to an upper time frame, it is just a single touch. In the previous examples, we have the trend lines on both sides of the market. However, it is not necessary. Here's an example of the trend line of only one side. We need to update or expand the trend line as the market develops. Here's an example. First, we draw the trend line like this. However, as the market develops, the previous trend line doesn't work anymore. So we draw the second trend line. And then we draw the third trend line. So in the end, you can see the market follows the third trend line here. To apply the trend line from an upper time frame on a lower time frame, it is better to treat the trend line from upper time frame as a band. Here's an example. The top chart is the 4-hour chart, and the bottom chart is the 15-minute chart. You can see that if we use the upper time frame trend line as a value zone or a band, it will be more reasonable to see the behavior approaching the trend line. We also want to combine the trend lines from both upper time frame and lower time frame together to assist our day trading. Here's an example. At upper time frame, we have trend lines with a downtrend. However, in a smaller scale, we also have the breakout here with the lower time frame uptrend. Then we know we can have a short position ready there. And also here we have a market touching the bottom trend line of an upper time frame. That's why the market goes back up. There are a lot of tools out there for the beginner day traders to use for day trading. Trendline is one of them, and the Trendline is one of the most powerful and reliable one. Support and resistance levels are also reliable because they are also human behaviors. Support means there are buyers coming in, and resistance means sellers are coming in. There are other indicators, thousands of them. However, most of them are lagging indicators. That means they don't have much forecasting power, but they are very good indicators for confirming the trend start. You can also use computer models, but it takes time and effort. And also, one of the biggest issues for the computer models is the curve fitting. Now let's move on to the second part, the trend line in day trading. Mainly, there are two ways to use the trend line. The first one is to use the trend line as the support and resistance levels. And the second is to use the trend line breakout. Let's first take a look at the trend line support and resistance with one side of the trend line. Basically, after you have a trend line drawn, you want to trade when the market comes to the trend line for the third touch or for the fourth touch. However, the third touch will give you the highest probability. There might be fifth or sixth touch. However, the probability will be very low. In terms of the profit target, it should be very realistic. That is because there's no other trend line at the top. It's hard to decide where the trend will go. In this example, if you trade the third touch, it is not realistic if you put your profit target at the top of this high. And also for the one side of the trend line, it's better that you trade with the trend rather than against the trend. That is because when the market goes up, it's hard for you to decide when it's going to reverse. For the trend with two sides of the trend lines, the same thing, we can trade the third time and fourth time touch. In this example, we have short opportunities here, and we also have buy opportunities here. In terms of the profit target, since we have two lines here, we can set the profit target to be the other side of the trend line. If the trend line have a wide range and also the trend is not steep, there are two ways of trading, both long and short. However, if the trend is very steep, you should only trade with the trend direction. For example, here, we have the third touch and the fourth touch. They are very good long opportunities. However, if we want to short, the market will go make another higher high, so you could easily to get a stop loss. Let's move on to the trendline breakout. There are two scenarios. The first scenario is the trend line will break out to the opposite of the trend direction. For example, here, we have a downtrend, and then we have a breakout, and then it goes upward. So in this case, first, when the trend break out the trend line, and then we wait for the pullback, and then we trade the second leg up, or we trade for the third leg up. The good thing for this is that you can set your profit target as the measure move. So basically, you measure the first leg, and then expect the trend will go to the same distance for the second leg, or even for the third leg. The second scenario is the breakout can go to the same direction. The same thing, we wait for the pullback and trade for the second and third leg. This is the example. Here's a downtrend. However, the market breaks the bottom trend line, After it pulls back, it goes down for the second leg or possibly the third leg. The same thing for the profit target. We can use the measure move for the profit target. Now let's move on to the last part of this video. Let me use some examples to show you how to trade the trend line. Take this for example. First, we can see that the market is going down. Here comes the third time of the touch. However, we are in a downtrend, and then if you want to trade the upward, that means the probability will be low. Second, if you see the chart here, this part, there are a lot of overlaps of the bars, which also means the market is not strong, which also means the probability of this long will be low. So for beginner traders, it's recommended not to trade against the trend. As you become more experienced, you can definitely trade this. So let's make this part a little bit bigger. We are waiting for the pullback and then wait for the bull signal bar. Here comes one. However, this signal bar is weak because the body accounts roughly 30% of the whole candlestick. And then for the next bar, it's also a bull bar. And though it is a hammer, however, the two bars combining together means the market strength for going up. So you can trade at the top of these bull bars. The market will go up. However, you should expect the market to come down to test the low. That is because, first, it is a downtrend, you go long. Second, the bull bars here are not strong enough. After you enter the market, you can see it comes back to test the low for two times. Here's the first time, here's the second time, but they also failed. And then market goes up to touch the top trend line. So in terms of the profit target, there are two options normally. The first one is you use n times the risk, which is based on back testing of all the historical charts in the same situation. The second is the top trend line. Here it reaches the top trend line, you can see. Another thing for the this leg up is that this part, you can see there are a lot of overlaps as well, which means the buyers are weak. When the market comes to the top trend line, the third touch, there's a short opportunity. So basically, we are waiting for the market to reverse to the downtrend for a signal bar and enter the market. Let's make this part bigger. So basically, you can see there's a bear bar here. However, the bear bar is weak. And then the next bar is also a bear bar. Basically, two bear bars means the strength of the selling side. So you can enter the market at the bottom of the two bear bars here. However, you can see the next bar here, it didn't pierce your entry levels. So you didn't enter the market right after these two bear bars. And then the market goes back to test the top trend line again, and then it reverses. After this bull bar testing the top trend line, the market comes down with a very strong signal bear bar. This signal bar is strong because the body accounts for over 60% of the whole candlestick, and then you can trade downward. After that, the market comes down to test the bottom trend line. Again, your profit target could be n times of your risk, or you can set the bottom trend line as your profit target. Another thing you should notice is that the downward trend is quicker than the upward trend here. Now let's move on to the trend line break examples. Here's the break of the trend line. We can see that the breakout is strong. That is because we have 6 consecutive bull bars breaking the trend line. And also, the trend is breaking the previous major high here. It's higher than this high. That's why the breakout is strong. For the trendline breakout, we're waiting for the pullback to trade the second or the third legs. So here, we can see there's a signal bull bar here. That is because this signal bar is testing the previous minor high here, and then it pulls back. That's why you can enter the market upon the close of this signal bull bar and then put at the top of the high of the bull bar. However, the market didn't go up immediately. Instead, it comes back to test this trend line again. So they are the second and the third signal bars. Those are also good signal bars for you to enter the market. In terms of the stop loss, you can use the previous pullback here as your stop loss, or you can even use the bottom of the channel. Really doesn't matter. These are the protective stops. As the market goes up, you should put your stop at the pullback bottom here. This is your actual stop for you to measure your risk. In terms of the profit target, there are two options. First is you use n times your actual risk, which should be based on your backtesting of the historical charts. The second is the measured move. Basically, here's the first leg up, the 6 consecutive bull bars. We measure from the bottom of the first bull bar until the top of the last bull bar. And then we measure again from the pullback and then the same distance. You can see that the measured move ends at this bear bar. That's because there are other traders using the same measured move mechanism to take profit. That's why the market pulls back a little bit there. As the market continues to go up, you can trade for the third leg. How you identify the pullback for the third leg? First, you can use the 3 pushes pattern. Basically, you can see that this leg up, there's one push with a bear bar, second push, and the third push, and then the market resumes up. The same thing for this pullback. The first push, the second push, and the third push, and then market resumes. So the same thing for this pullback. We have one push down, second push down, and the third push down. So after the third push, you can enter the market at this bull bar here. Another thing is, because we don't have any resistance and support level on the left to serve as the reference, we can use the EMA. So here's the 10 periods EMA that you can see the market comes back to the EMA and the EMA acts as the support. So that's a good timing for you to enter the market as well. On how to use the EMA, I have a video in my channel so you can search for reference. Most of the trendline breakouts will lead to very good trending. So for this example, there's a very good trend. You don't want to scalp. Basically, you want to scalp and swing at the same time to take more profit. So one of the ways that you are using the scalp and swing is after you enter the market at this pullback, you can target half your position at one time of the risk, and then another 1/4 at 2 times of the risk, and then swing the rest of the 1/4 of your position to the end of the trend. So in this way, at least when you take half of your position off at the one time of the risk, and then you can put your stop loss immediately to your entry level to make sure that you're not losing anything in this particular trade. So not losing is very important to the beginner day traders. If you enjoyed my video, please don't forget to subscribe, like, and comment. You can also go to my channel for more videos. Thank you.